Warriors. Let's have a great week. Everyone doing okay? Have an excellent guest. A lot of buzz on Twitter about Michael being with us at IMCT. I know Michael spawned many great traders in their own right from his teachings. So, you're very welcome, Rich. It's a pleasure to have Michael with us. Good morning, Spencer. And unlike it just being spontaneous, Michael has prepared something that he's going to. Michael is your mentor? Okay, Rich. So he's going to be talking about daily biases. And I saw a tweet where he said if he had known this 26 years ago, probably could have saved him some aggravation, huh, Michael? All right, so, that's what mentors do. You can't learn experience. It only happens with the passing of time and living through stuff. And so then as a mentor, what you want to do is you want to save people you're teaching, guide them around the landmines that people that are teaching have already stepped on, and show them a few things that they could concentrate on that could work for them if it matches up to their personality. Okay, so I'm schizophrenic, so I like reversals. Okay, anyway, getting to the markets, everyone in here knows that Turnaround Tuesday last week was my trade selection. It was a little early. It was shade under 66. It was at 580. We had one more poke to 6.5, and that didn't confirm on the 1 hour or 4 hour. And then so I laid out in green lines where you would be getting market tells that there's something going on that's negative in crude, right? So the first one was we kept holding the 65.5 level a few times, see? Broke through it, held it, popped to new highs, pulled back, tried to make new highs, couldn't. So if you had just had sell stops under 5.5, that would have been a good entry. The next area was this breakout area, okay, that a lot of people were saying it was a breakout, and it was. And that too was negated. So if you had just gotten short on the failure of this support level, you'd be okay. And then my big kahuna is this rising wedge line, which it cracked through at 64.70. And then when you go macro, pretty ugly week. Here's your red candle. So it's trying to hold this moving average under 62.16. 62.08 is where the 50-week moving average comes in. This week's off number is here. We close under 63.68. No, excuse me, it's this one. 63.92 by Friday. That'll be a 2-week reversal confirmed. So, okay, so you missed the whole thing, and a lot of people are talking 70 and 75 and even $80 crude down the line. But even if that's the case, isn't it possible after a $24 rally that we could have some type of fib retracement? 38% of 24 is going to be about $9. Takes you down to about 57-ish, right? Halfway, 12, 54, 61.8, 14. Takes you down to 52-ish, and then we make another advance. So that's a possibility. The other possibility is that we've reactivated this megaphone formation, which this was a throwover. And if that's the case, I don't think anyone's talking about it except some of the super bears like Henrik and some of the other people I know. I think Peter Goodburn, talking about the January lows being taken out. So the scenario is be short things that are economically sensitive. And, my good friend Jim Welsh says, he turned constructive China several months ago. So I'm saying, well, Jim, what I'm seeing in oil, if that's a top And then especially what I'm seeing in copper, that doesn't sound like a bullish setup for China. So here's copper, right? So when you look at it on the big picture with what the S&Ps did, we really didn't even get back 61.8 here on copper. To me, this was pretty directional, or as analyticians would say, impulsive. And then all we've done is mark time to relieve this oversold condition. And a lot of people started getting constructive here, and I understand why. But look at the last 3 weeks and how we're starting out here. You know, back under this moving average 282, which is a little bit under this low. I really don't see anything. There's something right around the mid 270s, but all the way down to 260. So my narrative is that there's going to be fear of a global slowdown that's going to upset things, and these two commodities are my market tells for that. So will there ever be a correction in the S&Ps? We're almost at new highs. Just missed it here. NASDAQ already at new highs. Oh, 1, 2, 3. So it could be a classic J.R. Hill, 3 drives to a top up here. I really don't want to lose my focus in crude, and this is what I'm doing in crude. And you have to admit they've been Siamese twins, right? Crude and stock indexes, although the magnitude of the move in the S&Ps was much stronger because it made new highs, right? NASDAQ made new highs. NAS challenging it. Okay. S&P's challenging it. What was the high? 29.42. So far, the high is 29.40. So we'll see if they do it or not. I think there's a short setting up here in S&Ps, and the first week of May, you know, this runs into the first week of May. Within the next 5-day trading days, by the end of May and June, you know what you're going to be hearing on CNBC and Bloomberg and all of those other shows that should have me on there? People will say, well, it was easy. Sell in May and go away. And I think that there have been several years where that hasn't been a smart strategy. But the levels that indexes are at, and what I'm seeing in crude and copper, if I'm right about a long-term scenario for sharply lower prices in both, sell in May and go away might be a good idea. Or maybe at least, you know, stay tuned in June. Maybe it'll fly in July. And I don't have any word that rhymes with August. So getting back to the dollar is, and I don't know for me right now. I mean, you got to give the benefit of the doubt to this breakout here over 97.80. But when I look at DSI, it's just so lopsided. I think Euro's back down to about 13, 14. By the way, thank you, Blake, for sending that out to me. I know it's just another tool. It's like COT and Euro. It looks like it could be, you know, trying to bottom. Jim Walsh is looking for a bottom. Jim's pretty good. I said, yeah, but Jim, people are talking 99.20 into Dixie and 102. He says, I know, but he's talking about the daily divergence here in Euro. So I don't know. You know, my bias is to try it, but not here. You know, I'd like to see this low here. This was a spike low. I don't even remember how this happened or when it happened. But we have NFP, we have the Fed. So, you know, I don't like to be heavily positioned into it. And I'll just wrap it with what I'm looking to do in crude. Okay, guys? Everyone with me on what I said? I know I jumped around a lot. Actually, my ideal scenario for the dollar would be based upon the euro and based upon this line. So that's coming in, you know, in the next quarter or so. Rich, down around 105.80. And what a coincidence. I mean, most of the bears are talking under, you know, under parity, 90. The extreme bearish case for euros, 80 cents. All right. But wouldn't it be something if we're heading down here, just like when we were here, everyone was talking about sub parity. We'll be hearing about the parity bears down here. And maybe all it's doing is retracing the Macron gap and puts in a higher low. But I think the fundamental event for the dollar is when the Fed flips for real, not just jawboning that they're on hold and maybe there's going to be, you know, if they need to, okay, will actually be a shift in Fed policy. Now, you know, everyone's always saying we already had a shift from tightening to doing nothing. But I think for now, as long as the bonds look okay and the dollar looks okay, you could probably should only probably be long those. Michael will be on at the top of the hour. Sparks. Okay, so we do an hour of analysis. And speaking about analysis, pretty good team of analysts here. Okay, and I think what differs us from most websites, they'll have one style. Okay, so everyone knows Blake, and he handles the, you know, traditional, conventional type of technical analysis. A great trader got recruited by a boutique firm that doesn't take anybody. Everyone knows Grega. I've interviewed Grega on FX Street when he's winning awards, and Stelios used to do 7-figure trades on LIBOR for banks, and Steve gives one of the best rundowns, also contributes to the letters. Stelios does the macro stuff. So far you have Elliott Wave and conventional, and Joe is our point man. He's our company spokesperson on Bloomberg and Real Vision. And Paulie has a session called the European Crossover where he lays out all his technical points for the session ahead. And he's excellent. You have to be a member to get that before FACE. And Amanda, people love her. She moderates in our members chat. She's trades for a living, and she's been pretty bullish the dollar. Andre's a great harmonics teacher and practitioner. So a pretty good team that we've assembled here at ForexAnalytix. So you get traditional, right? All the different kinds of analysis that you get. You get Elliott, harmonics, basic technical, sticks, and macro. And everything's right there for you, okay? Not just the picture, but the explanation and the takeaways. And we have push alerts. Maybe someone could push an alert that's going to show up on any of your devices if we see something. And, you know, we're working longer than just FACE. So with that being said, as I said, we have analysis for another 45 minutes before Michael joins us. Blake, how are you? Hope you had a great weekend, buddy.
Hey, good morning. How are you?
How are you? Okay, bro.
I'm doing well. You know, today, since Steve's not going to be here, I got a little bit of a special day for you guys today. I'm going to go through all the majors, and I'm gonna you know, develop you guys the bias chart. I don't always do that on a daily basis because I just don't have the time here when I'm filling in. But today we have Steve is out, so I'm gonna go ahead and take over and do just the basic analysis for all the majors as I sometimes do. Like I said, when it's usually when Steve is out, and Steve happens to be out today. Now, before I get started, I did want to say I hope you guys had a great weekend. How about you, Coach? How'd you do this weekend?
Oh, I was fine, Blake. It was very nice here in San Marcos, California.
Ah, got it.
You know, that kind of moist ocean
Yes.
breeze with a nice warm sun and the clouds just drifting over and listening to the waves. And God, it was a rough weekend, Blake.
All right. Well, for us, we start. I start playoff weeks for my son for his
Oh,
baseball,
cool.
and today actually the
Before it
my
gets too hot.
yeah, my kids have my kids are going to get we do an annual ditch day, so they get to take one day off, and they don't know it's coming. But tonight we're going to see the Avengers Endgame movie. We couldn't. There's a theater that we go to that we can pre-buy or pre-purchase the tickets and get the seats that we
You
want. And
know, we had that as a kid, Blake. My mom, who was such a fanatical Cub fan, when Leo DeRocher, I know it's a long time ago, was the manager of the Cubs because she knew him from LA. She'd come and take us out of school and take us to the ball game.
well, we're doing the same thing today. We're taking the kids out of school and they get to go to see the Avengers Endgame movie
Nice.
because so this way they don't get spoilers from all the kids that saw it over the weekend. But we couldn't get tickets for the right time over the weekend because trying to get they just sold out, and I bought them last week, but they sold out for the theater that we usually go to. So
You know,
anyway,
great dads make great traders because they pay attention to all the details. You know,
well,
your kids are like, you know, a precious instrument, unlike Euro, and you pay attention to every movement. That's really something, Blake. I mean, what you do as a person translates into your trading.
great. Well, I don't know about that. We'll see. But thank you. Appreciate it. But what we're going to do is we're going to go through all these majors, and you can see I'm already developing the bias chart for the euro dollar, and I'm going to do it for all the majors this morning since like I said, I have the time. Now, with the euro, really quick, what you'll notice is we're still in breakdown territory, just as the dollar index, and I'll go into that chart, in more detail here in a moment. But it's still in breakout territory. The euro is in breakdown territory. Now we have this nice bearish wedge. Everybody knows that we had the false breakout above the trend line, which leads to a breakdown. Whenever you get a breakout, the chances of a reversal going the opposite direction is quite high. In this case, it was obviously a breakout to the upside. Failed breakout should have led us to a breakdown. ABC just takes us down to 110.50 roughly. And so I'm expecting us to eventually get down there. And as long as the 111.75 level holds, which is the breakdown point. You'll notice also on the hourly and 4-hour charts, especially the 4-hour here, we've reset our relative strength. So relative strength was oversold. We've worked off those oversold conditions, which is good if you're bearish because it allows us to reestablish that downtrend, and where relative strength can dip back into oversold territory at some point, especially if the euro makes it to new trend lows to the 161% extension. You also notice on the hourly and 4-hour charts we're making a lower high. So making a lower high, especially overnight. And by the way, I had an order to sell euros at 111.80 just in case we got there. It's actually at 79. It never punctured new highs because what I was thinking might happen was we were going to get some sort of bear flag pattern overnight. So I was trying to sell up here. Didn't happen, which I had to go ahead and step into new fresh shorts already as I woke up this morning. Because obviously I sleep during the European hour, so I didn't get a trade off higher, but now I think that the euro dollar, as long as we stay below this 111.75 level, remains some downside pressure here. So support for the euro dollar, which I think is going to be pretty important today, is going to be right here. So this is where key support is going to come in. 111.20 to 111.10. That's like a support zone, which is going to be really, really key for the euro on the way back down. So what I'm going to write down is 111.12 will be support. Now, if you are looking at this bias chart and you go, well, what does the asterisk mean? The asterisk to me means it's a very important resistance. So for example, the euro dollar should not see the light of day above 111.75 now. It really shouldn't. If it does, that really would be to me, it would be a pretty good indication that we're probably got some sort of false breakdown here, and then we're going to start squeezing. But until that happens, we have to assume that the downside still prevails here, and we have this AB. So you can see A, B. I know I should probably make that a little bit clearer, but C, a little bigger, and this would be D, right? So now, why is this important that we note the what we're seeing here? Because if I can as a trader, identify that, okay, the bearish trend is still intact, we're looking for an ABCD, that means that my bias right now is going to be for a bearish euro. I want to play the euro to the short side. Unless we break above the 111.75, my overall analysis is going to be bearish at this point. All right, so let's we did the euro. Let's go over to the cable. So here's the cable, and by the way, we do have some data coming out. We have PCE data coming out, which that'll be out in about 7 minutes. So I'm going to try to crank through some of this analysis, at least into the dollar yen, before this data comes out. So here's the cable. Now we know that we have this bearish wedge breakdown, also very similar to the euro dollar, this resistance zone, and you can see the downtrend line. This previous support, which acts as current resistance, comes in at 129.60. I actually had an order to sell the cable at 129.60 overnight. Didn't get hit. We've been as high as 129.47. I am not short right now. I didn't manage to get a new pound short off overnight, but right now, as long as we are below 129.60, and I'm hearing some feedback. Is that you, Coach? Oh no, that looks like it's Steve. So I'm going to go ahead and mute Steve. I don't know what he's doing here today, because we told him to take the day off and go spend some time with his family. He shouldn't be here right now. Nope. Let me go ahead and mute him. There we go. He shouldn't be here right now, but he couldn't help himself to just start talking. Hold on. Whoop, there, I muted him again. See, it's hard to even get rid of him. We can't even remove him from the webinar. Maybe I'll have to block him. It's like he can't help himself, Stelios. I don't understand. Look, he unmuted himself again. Hey, what? Look. Oh, there. Oh, I muted him. Oh, look. Go spend some time with your family, man.
I say we fire him.
Okay, Steve. All right. I'll unmute you. What are you doing here?
I'm not there, actually.
No. What are you doing here? Go spend some time with your family.
Everybody's eating currently, so it was a good opportunity for me to
talk.
To get in the car and jump in.
To talk. Okay, so so he can't help himself but to go ahead and talk. Stelios, what's wrong with this guy?
I don't know. Been asking myself that question for years.
All right, see, you Greeks. Okay, so anyway, this 112.65 is going to be trend lows. We have a possible bear flag developing. It's the same story with whether you're talking about the euro, you're talking about the cable, all the same looking charts. As long as we stay below these key levels of resistance, the overall arching theme is continued dollar strength, and the 50% retracement right here has been holding. I do think that based on a basic bearish wedge formation, minimum target takes us from the breakdown point here, takes us down to this 126.75 level, which is a spike low from back here in mid-January. So I think this is a realistic expectation. We could actually extend even further than that, because if you go to the to the upper end of this wedge that looks like this, we could actually extend further than that, depending if the if the bearish, you know, cable wanted to really, you know, extend itself, we can have this upper sloping trend line. You can see right over here come right back into play, which takes us to 125.80s. And I'm not expecting that right now, but that doesn't mean that that cannot happen. So I'll stop for a second since Steve obviously has something to say. So good morning, Steve.
Good morning, Blaker. How have you been?
Good, good. So what's going on?
Nothing. I jumped in case you wanted some help because I do have a little bit of time. Like I can spend several minutes here. So I know that you're busy. So it's up to you. My connection seems to be good. So it's totally up to you.
No, I've got it. I already planned on being here today. We've got this. Like I said, we've got some economic data coming out in a few minutes. I was just trying to get through some of this analysis before the data comes out.
Okay,
So
perfect.
We're
Perfect.
good.
Then I'm going to let you do it. Let me just say that we posted yesterday with Stelios, yesterday night, a blog post about crude. As everybody knows, our blog is free to visit. You don't need to even be a subscriber. So I think people should go ahead and read our view on crude and the reversal we saw at the end of last week.
Great. And so if you're on our website on ForexAnalytix.com, there's one of the titles or one of the pages you can get to is the blog, and you can see the crude oil blog right here. So make sure you click on that and get an opportunity to read that when you can. So thank you, Steve. Thanks for putting that out over the weekend.
My pleasure. Have a wonderful day.
All right, you do the same. Enjoy the family. All right, guys. So let me just crank through the dollar yen, and if you watch the week ahead video, as I pointed out, it's not all roses for the dollar. I think I used the term roses, rainbows, and unicorns because the dollar is breaking out against a lot of currencies, but not specifically against some. And the dollar yen it falls into that category where the dollar yen is trading a little heavier. Now, what's really going to put some downside pressure on the dollar yen is if you start to see equities come under some pressure. But the yen is already showing some strength. So if we get yen strength and dollar strength, and that means currencies like the euro yen, Aussie yen, New Zealand yen, the guppy, those will come under pressure as well. So what I'm looking for right now, just with the dollar yen, is that we have, I would say that we're mid-range currently. You can see this, obviously the support around the 111.50 or 111.40 level, but if you can take us all the way back up to 112, which would be the underside of this trend line, which I think will offer some resistance. Now, what you'll notice is we're smack dab in the middle of this range. Ahead of this, we do have, you'll notice here, we have PCE, personal income, personal spending, some inflation data that I think that the market's going to be looking pretty closely at today. Some stronger data could push us back up towards 112 in the dollar yen. Weaker data could obviously take us back down towards 111.50, 111.40, which is going to be really important. Now, so for today, let's write down the 111.40 levels being support. We're 1 minute out, so 111.40, 112 is resistance. We are in kind of I would say we're in range environment right now with the dollar yen, and that's, you should note that, because even though the dollar is bullish against the euro and the cable, it's really more range bound against the yen. So like I said, the dollar is not bullish necessarily against the dollar yen, where it's bullish against a lot of other different currencies. So I'm going to keep it on the 5-minute chart here. And I'm going to bring over my Bloomberg terminal. This is, for those of you guys that do not know, this is Bloomberg. So you'll see the data come out here way before you see it on Twitter or anything else. So watch this personal income spending. Here's the PCE numbers that you need to be paying pretty close attention to. And we'll see them break here. There we go.
1.6 versus 1.7 core PCE
yeah,
slightly.
And the dollar is not having a very good response to that data, and probably has to do more with personal spendings dropping a little bit. personal spending's higher, personal income's lower, and the dollar is coming under a little bit of pressure. So we are seeing a little bit of dollar pressure coming in right now. PCE came in a little weaker than expected at 1.5% versus 1.6%. So we are seeing, like I said, a little bit of dollar pressure coming in. So here's the euro spiking up. I'm gonna, be adding to my euro dollar exposure on the short side if we can get up towards 111.60s, like into the mid 60s, like 65. I don't know if it's gonna allow to extend that far, but the dollar yen showed you the immediate reaction, which usually does. It's the currency pair I tend to pay most attention to during releases, but the dollar yen spiked down in a quick reversal here, so we're not getting much downside follow through. Equities are holding up pretty well. Overall, considering we have such a busy week this week with data, well, not just with data, but with we have non-farm payroll obviously on Friday, but with the Fed on Wednesday, it's been a pretty slow start to the week. That data is going to weigh a little bit on, FOMC expectations going into Wednesday, as inflation is not rearing its ugly head once again. And this is probably going to start igniting a little bit of talks about, the Fed not necessarily cutting rates, but it could cut rates slightly on its reserves, and that's something that we're going to have to watch out for going into this week. All right, so not a whole lot of movement here. The euro, spiked up into the 60s, but didn't make it up and around the 65 level where I'm looking to sell some more. So overall, pretty
Blake,
much non-event. Yes, what's up, Stelios?
Sorry to interrupt. I just want to point out that the Fed Fund futures curve is actually implying one rate cut by the end of this year, actually very early next year. So 25 by that time, and another 25 next year. So we have to keep in mind what the market's currently pricing in, which is 2 cuts within 2 years. And on the other hand, the euro curve, the Euribor futures curve, is actually pricing a very, very slight chance of a hike within the next year and a half. So that's what's currently priced in. And so the market actually has to give us that for things to stay as they are. So it's
yeah, and this is exactly what you're talking about as far as cut probabilities, for the U.S. So. And this is exactly what Stelios is talking about, and this is via Bloomberg right now. Let me make this a normal size. There we go. So you guys can kind of see the data that Stelios is talking about here. Okay, and it's interesting. I'm doing a lot of reading over the weekend about how there might even be the interest rate on reserves being cut maybe by 0.5% or 0.05%, excuse me. This week there's some chatter about that as well. So and a lot of people will initially think that is a dollar negative, but I think that any type of dollar negativity based on interest rate cut would be quickly reversed on reserves. But that's an opinion. But let's
Blake, if I may interrupt one more time, sorry about that. I just want to add my view on that. Cutting rates is one thing. Cutting rates from reserves is a very different thing, because that's like the name says, it's on excess reserves that the bank have. So if they don't deposit it, if they get less incentive to deposit it with the Fed, and they do something else with it, well, then that in theory is positive.
There you go, and that's a great.
So, Stella, is that to encourage banks to loan instead of sitting on their cash?
Yes, although banks can't actually directly lend out their excess reserves. It's actually it's quite complicated how it works, but it's definitely an incentive for them to
do
find
something besides.
Other ways. Yes, yeah. Besides just putting it with the Fed and just getting interest back.
Because money velocity has been rather slow, hasn't it?
Well, for the past decades, right? It's been going down to all-time lows. So yes, absolutely. Okay. And that's one of the main reasons why we're not seeing any proper reported inflation. It's very low.
Okay, thank you, buddy.
All right. Well, you know, it's unfortunate. I don't really think I'm going to be able to squeeze off another euro ad here in the 60s. The euro's already starting to show some signs of weakness, which I'm not going to be chasing it lower here because I've already started establishing a position. But yeah, I'm still in the camp that if we can get a move up here, you know, I'll be looking to add a little bit more. Let's go ahead and try to cram through some of this analysis here in the Aussie and the Kiwi. You know, the Aussie, the bounces have been really shallow. Now, one of the things that and this is from last week, I'm going to have to delete this. One of the things that has led to an Aussie bounce has been this little false breakdown below 70 cents, and then we've rallied a bit. We haven't even been able to get to the 38% retracement, but I do think that this is going to be, you can see this breakdown point here. This is all going to be resistance through here. So this is, we're kind of already into the resistance zone for the Aussie, but I think any move up to 70.70, which is a 38% retracement, is just setting up for what could potentially be, and like I mentioned with the other pairs when you're talking about the euro and the cable, a possible bear flag pattern, which I think sets up great for a continuation of this downtrend. So as long as we stay below 70.70, and I'm going to go ahead and write that down, we remain in the bearish camp for the Aussie. Now, support for the Aussie probably going to be somewhere right through here. This is a 4-hour chart, so just there's like a little plateau of support. You got these spike lows over here, spike high right there, some of these lows that come in, and that comes in around, let's say, roughly 70.30. So this is going to be a pretty minor support for the Aussie, but I think it's something that we should pay attention to should we get down there. Let's go over to the Kiwi. Very similar situation with the Kiwi. We had a false breakdown below the 66-cent level. Now this is important because the Kiwi has kind of been outperforming the Aussie. And you can see that little slight breakdown below the 66-cent level, 65.80, just touched lows, probably whacked a few stops just below here, and then we rally back. Now, there's a downtrend line that comes into play right here, and that comes in around the 66.85 level. So as long as we stay below 66.85, the trend still remains bearish. And that's despite the over or outperformance of the commodity currencies. Now, if you ask yourself, or you ask why has the Aussie and the Kiwi really outperformed the euro and the cable, and that's because if you hadn't noticed, as Dale pointed out a little bit earlier, stocks are at all-time highs. You got the S&P that's marking up. Might have actually been new intraday highs today on the S&P, pretty damn close, right there, right through here. We're matching those highs, and then you got the Nasdaq that's at all-time highs. So if you wonder why the commodity currencies are looking a little bit better, it's because of that outperformance of equities. Should we start to see some selling come into equities, later on this week, you'll probably see the Aussie and the Kiwi both respect the fact that equities are coming off, and you'll probably see those come off at a little bit quicker rate. Now, the one currency that we have to pay pretty close attention to is the dollar Canadian, and I think the dollar Canadian is looking really strong despite the rally in crude oil, and that is that's not good if you're short the dollar Canadian, because if you start to see crude oil show some signs of weakness, which Dale, you were talking about the possible throw over in the megaphone pattern. That's just going to weigh on the Canadian currency. So I think this Canadian is holding up very well, despite, like I said, the rally that you have in crude. So I think we have to pay very close attention to the dollar Canadian on any move above this 127% extension. I say 127% extension of the range, this triangle. Remember, we had a false breakdown here, led to the breakout. Okay, so now any move above 135.25. Oops, I forgot to put in the. Hold on, I'll have to go back. I have to go back and revisit the It's going to be important resistance. This is still a bullish trend. Let me go back to the Kiwi really quick. I noted support. I just didn't write support. So that support right down here is going to be 65.80. Whoops. Okay. Sorry, going back to the Canadian. All right, so here's the Canadian. And as far as the Canadian goes, this is the triangle breakout. So this means that this move right here, or excuse me, a retest of this triangle is going to be extremely important should we get down there. I don't even know if we're going to make our way down there, but if we make our way down to 134.20, it's going to be pretty key support. So 134.20. Pretty key support on dips. Look at the euro. Wow, that thing's heavy. That weak data today couldn't even allow for the euro for a retest of the 130 or 111.70 level. That's not good for the euro, and everybody knows that.
Sorry, if I may just point one more thing out. We had the Spanish general election so over the weekend, and there's a bit of.
Tell us a little bit about that, Stelios.
Yes, well, there was no clear winner, so we had the PSOE, which is basically the centre left party, which came top at 28% or so. But they will need to have now some kind of cooperation with another party. Yes,
right.
And the Popular Party, which came second, which is the centre-right party, well, they're never going to be any kind of cooperation with them. But there is the third party, which is called the Citizens Party, which got 16%, which is in terms of ideology pretty close to the top party. And everybody's been talking, oh yeah, there's going to be a coalition there. But there is only one problem, which is. About an hour or two ago, the leader of the Citizens Party said that there is not going to be any kind of negotiations for a government with the PSOE, the leading party. So that's at the moment seems to be going out of the window. So what we're seeing is a situation where we have basically four parties with over 14% each, It's looking relatively difficult for a government to be formed. Now, I'm not saying it's not going to, because I'm not an expert in Spanish politics, but the obvious choice seems to be a non-starter. The other interesting thing to note is that the far-right party, Vox, they've got 10%. So this is, again, something that we've seen all across Europe. We've seen it here at home in Greece, 10% the far-right is getting, and it's very, very worrying. It's just something to keep in mind. So basically what I was going to say is the euro is heavy partly because there's this situation in Spain where we don't know how this is going to end up.
Well, thank you for pointing that out, and that's definitely one of the things that's going to be weighing on the euro, despite just the overall arching theme of dollar strength. So thank you, Stelios. Okay,
no
so
problem.
let's see. We got about 15 minutes or so, and I definitely don't want to take away from the guest that's coming on today. I know a lot of people have tuned in to see him specifically, so I'm going to make sure that I wrap everything up in time. So let's go over to the peso. So the dollar Mexican peso, we had this double bottom basically completed. When you get this close to a a target, you can see it right here, and we came pretty much within striking distance of that double bottom. I count that as completed. Now, one of the things that really stood in the way of it stretching any further is the big 618 retracement. You can see it right here. Let me grab this fib if I can grab it. Come on, man. Hello. All right. Now you got me irritated. Whoa. Okay, well, it's in pretty much in the right spot. But what I was telling you, I was trying to show you. Oh, that's irritating. The 618 retracement, it came in at 1920, and we came just within a whisker of that, and then we pulled back. Now we're back testing the 618 in the dollar mex, and so while we're above, and you can note this number right here, while we're above 1890, the risk now is to the upside. So 1890 is support for the dollar Mexican peso. 1890. And resistance now will probably be a move right back up to here, because this, you can see that previous resistance, right? So let me just grab this. And you got this previous support that held us right here. So that's going to take us right back to 1901 roughly. And that's going to be some resistance going into today. Kind of minor, but worth noting. And I would say in the dollar Mexican peso, we are range bound. This is where you can see the dollar's performing well against a lot of different currencies, not specifically against the peso. However, the dollar Mexican peso, or as we like to call her, Salma Hayek, or the taco, whatever you want to call her, the dollar Mexican peso is it will perform better in an environment where there's more risk aversion. Right now, obviously, there's not much of that, but if we get in a risk-off type of environment, the emerging market currencies, whether you're talking about the South African rand or the peso, or maybe the lira, like the Turkish lira, those are going to underperform. You know, you'll kind of toss out the currencies with the higher interest carry. They get thrown out with the baby and the bathwater all the same. All right, let's take a look at the Swissy. Now the Swissy, you know, late last week we had this little breakdown of this wedge. I still feel that the dollar Swiss, it's pretty bullish, and we could really still extend our move up to the 161% extension of the last major move down, which comes in at 102.66. I am, and just so you guys know, I've had an order sitting out here for the whole week last week to sell the dollar Swiss when we get up to 102.66. That is a key resistance for me. I am looking to actually put in a bit of a reversal, but what has to happen when that gets triggered, if it gets triggered, let me just write this down, is that we have to see a little bit of risk aversion creep in shortly thereafter. So we are bullish right now, even though I'm looking for a little counter trend move. It's still very much in breakout territory. If you look at the daily chart, we've taken out a multi-year trend line. Okay, so I still think we can make our way up here. The one thing about the dollar Swiss that I must note is that you know, the real punishing negative carry it has if you're going to be buying Swiss francs. So in order for me to really stay with a short dollar Swiss trade, I'm going to have to see some risk off. You know, if not, the positions I take in the dollar Swiss will be more intraday type of positions. Now support for the dollar Swiss right now is going to be right through here. It's just going to be the 106.70. That's going to be, or 101.70, excuse me, 1.0170. That's minor support. It's in a bullish trend. Let's go over to the dollar index. The dollar index, obviously we're in a bull flag pattern. We are stalling at the 127% extension of the last major move lower. That has contained prices thus far. So that means the resistance right now is 98.33. It's resistance. That's key. It is bullish. Okay. Dips. And look, for me, I just hope we get a dip down here in the dollar index, because right here, this is my cue to really get long all dollars. So, or not necessarily all dollars, but you know, short the euro, short the cable, that type of thing. 97.70 is the breakout point. That is key support. And you'll notice how I put even 2 asterisks there. Why would I put 2 asterisks there? Because it's really, really critically important that we hold that to maintain the bullish bias. Now, let's take a look at some of these Nordic currencies really quick, and then we'll wrap up. And Coach, if you can do me a favor, Dale, are you around? Maybe not. Okay, Stelios, if you can do me a favor, if you can look at some of these comments and see if we have any questions that I can address after I finish up these Nordic currencies, I'd appreciate it. So the U.S. dollar, Norwegian krona, I've got what I think is a Garley pattern developing. So that what that means is, even though 870 is key resistance right now, I think we can actually extend even further. Okay, which means that a move to 874.50 I think is possible. Okay, so I think we can actually develop some sort of Gartley here. We have a nice little pennant that's developing. I think we could quite possibly even go further than that. Obviously, if the dollar kind of really took off, we could develop some sort of butterfly. I think we're heading up here to the 78% retracement, at least minimum, but we could go even further than that. So what that also means is that this spike low here is going to be really important for bulls to maintain, and that comes in at 865.50. That's support. Okay, and let's go take a look at the Swedish krona. Last but not least, now one thing about the Swedish krona that if you guys haven't looked, and you guys might have remembered this comment from me over the last several months, if the dollar breaks out, the place you want to be is the US dollar Swedish krona. If you look at the weekly chart, we're at all-time highs. Well, at least based on the data that I have here. Even on Bloomberg, I can't pull up the previous data. We're at highs, and that flag points a lot higher. That pennant right there, it points to 1025. I mean, that's a pretty big move from where we're currently sitting. And that's a weekly chart of the US dollar Swedish krona. Now, what does that mean for us right now? Well, what that actually means is that while we are above this 940, let's just call it 945, it's bullish. Period, end of story. There's no if and or buts about it. And if you're trying to fade the dollar Swiss up here, or the dollar Swedish krona up here, and you happen to make money, I think it's more based on luck and not anything else, right? This is a very bullish chart. It has been bullish. It's extremely bullish. It continues to be bullish. And if you are fading it and you happen to make money, consider it luck. All right, and we did stall near the 127% extension, so I'm going to write down at 960 is resistance near term. It's not great resistance, but beyond 960, we're looking at a move towards 974.70. Okay, and so this is your bias chart. For those of you guys that want to take a picture of it, to capture it, to write it down a little bit later on your own notes. There you go. All right, Stelios, how we doing with questions?
We have a couple.
Okay.
So first, we've been asked about Aussie Kiwi. If you want to have a look at that, we've been following that, right? You had a pattern in play which worked out quite well.
It did, and actually I moved my stops to 106, and it got it took my stops out, which left us with a really nice gain on the Aussie New Zealand. And if you guys don't know, we have these active patterns in play right here, and then closed patterns in play once they've been completed. And you can see the Aussie New Zealand was closed at 1.05%, so it was a really nice gain. And I've actually established a new long position in the Aussie New Zealand over the last couple of days. I actually have a core position, not as big as the one that I had when we broke above 104.50 right here. I had a much bigger position on the initial move, but I'm already reestablished a core position below 106. So I have one already developed, and you'll notice that we're holding. Let me get rid of these really quick. We're holding the 38% retracement right now in the Aussie New Zealand, and we do have New Zealand employment data tomorrow. Matter of fact, it's going to be on Tuesday afternoon, Wednesday morning in New Zealand. But my goal is or what my hopes are is the Aussie New Zealand trades back above 106, and then hopefully we get a weaker New Zealand number that plays into this move. But I'll put my stops right below the 38% retracement if that should transpire. I do think the Aussie New Zealand, a lot of people, especially traders, they tend to have very what do you call the disease, Stelios, where you have very short-term memory? That's it.
Actually, I don't know.
Okay, so just traders have a lot of pretty severe cases of ADD, and keep in mind that a couple of weeks ago there was a very big shift in the RBNZ, and how the RBNZ is now looking towards a rate cut versus a hike, and that caught a lot of institutions off guard, and that's what created this big move here in the Aussie New Zealand. The overarching theme is the shift in central banks. That shift was very big. Everybody expected the RBA to already signal a rate cut, which, you know, the data over the last week kind of to reinforce that, but we already knew that. So now moving forward, it's still going to be a repricing of the RBNZ. So I believe that we're still going to the 108 level, which, by the way, the 108.50 is the 618 retracement, this move right here. Okay, the 108, I'm sorry, it's 108.05, not 108.50. It's 108.05 is the 618 retracement. I still believe that's where we're going in the Aussie New Zealand eventually. And if you watch the Real Vision piece that I did 3 weeks ago, so for those of you that subscribe to Raoul Paul's Real Vision network, I did a trade setup of a target of the Aussie New Zealand at 108. That's still very valid to me, and I'm still playing into that particular trade. And I've made quite a bit of money this month trading the Aussie Kiwi. All right, Stelios, any other questions?
Okay, we have time for one more, I think.
Sure.
We have a friend asking for palladium, if you can have a look at that.
Shoot, I don't even look at palladium. How about you? Do you look at it? What's the symbol of palladium? Help me out.
Basically, the XPD, I think, XPD USD. The question is actually, is Steve not going to be here to do the usual analysis where he does cover palladium as well? So the answer is actually, he's not going to be here. But
the good news is I can always look at a chart and give you, and this is going to be a very unbiased view because I don't look at it at all, very rarely. Actually, you can see the drawings that I had on palladium was very, very very old. So what I'll tell you right now with palladium, first and foremost,
is that a flag?
Well, let's note that it's pulled back to 38% retracement. All right, and that means that key support for anybody who's bullish at this point, they don't want to see anything below that support, which comes in, let's call it 13, 10. All right, right through here. No one wants to see a break below that if you're bullish. The problem with this is it looks like that we might be developing more of a bear flag going the other direction. So if you go to, if you look at this, and you'll notice the 50% retracement. Let me grab a different. There you go. The 50% retracement is holding. So the way I'd be looking at this now is something that looks like this. And my opinion is we have a very longer term bullish trend, but as long as we stay below this 1470 level, I think the risk is, at this point, the risk might be for a move lower. So if it were me, and I don't trade palladium, so I'm going to give you that disclaimer initially, is that while we're below the 50% retracement, I'd be on the short side. We get above the 50% retracement here, above 1470, then at that point I would be like, okay, well, we're probably going to trade back up towards trend highs or try to retest the trend highs. But gold and silver both look dangerous for bulls. Palladium kind of fits into that category as well, especially with dollar strength. I don't know if I'd want to be playing on the long side of palladium right now with the strength of the U.S. dollar and the way it looks. So I hope that answers your question. Now we have about a minute before Dale brings in his interview. So I'm going to leave it at that. And guys and gals, if you enjoyed this analysis, the bias chart and what I've developed here, just remember Paul Franco does this every single day, every single session during the European hours for our traders that are part of the ForexAnalytix community. So if you want to be part of the ForexAnalytix community, but you want a way to possibly get it for free, make sure you check out our sponsors, Forest Park FX. They're right here, and you can be involved in the reimbursement program where you can use the commissions that you pay to your broker can help subsidize and you can possibly get ForexAnalytix for free, at least a portion of it for free. Their contact information is right here on Skype or email. This will get you directly to Forest Park FX. They're a great group to work with. We've worked with them for the last several years. The principals there, Justin and Trent, are some of probably the best people that I've found in this industry to be aligned with. They really just care about you, and they do that because it obviously only helps their business if you're successful, and that's in the same lines that we follow. We are successful if you're successful. So, and it's not about, for them, it's not about, oh, let's see how much money we can make. No, it's more of, let's make sure you guys are placed with the right broker that is aligned with the same goals that you have as a trader, and also, quite potentially you could be joining the ForexAnalytix community for free. So make sure you visit our webinar sponsors, that is Forest Park FX. With that being said, I'm going to pass it over to you, Dale. Guys and gals, thanks for listening in to me today. And I know we have a great interview coming up. So, Coach, I'm going to pass it over to you. Stelios, thanks for being here.
Got it.
And Steve, go spend some time with your family.
Thanks, Blake.
And, all right.
Okay, thank you, Blake. Good hunting today.
Thanks, guys. Have a great remainder of your day, and we'll see you tomorrow morning. And remember, for those of you that are just tuning in, we do this webinar every single trading session, same time, same channel, same bat channel, for those of you that are Batman fans. We'll see you here again tomorrow. Thanks.
Okay. Michael, I'm making you the presenter, my friend. Welcome back to FACE for your return interview.
You guys hear me?
Can hear you. Hi, Michael.
Hello, sir. How are you?
I'm fine, buddy. Call me Dale. Sir makes me feel older than I really am. And anyway, welcome back, Michael. I appreciate you coming back to FACE to edify our community, and many of your followers are here. Have you ever heard the expression, Michael, that some people teach and some people do?
I hear it all the time. I get accused of teaching only because I can't do it.
That's right. Okay, so you're a prime example. Not all could do it, but I believe that both could be done. And you could even take it to sports, Michael. I mean, I remember a lot of great player coaches. Okay, they were still on the court. They were still out there on the field. They were grizzled veterans. They could still play the game. And in our game, we don't have physical limitations. You and I could be doing this when we're 80 years old. But there are people that can teach and do. In fact, the best teachers are the ones that can explain what they do that's effective. If you can't do it, I don't know, what's there to teach?
Right.
How not to do it? So anyway, right. I think that I get that question too. I think we are player coaches in the trading arena, and it's great to have you back, and I'm looking forward to learning from you, Michael. I also want to congratulate you on what has manifested from your teachings. You know why? I've interviewed those guys. I've interviewed many people that attribute what they do now and how they've been able to pull money out of the market is using many of your methodologies that they learned from you. And so, that's a pretty cool legacy to have spawned successful traders. I don't know how you feel, but when my mentees are doing well, to me, it feels better than a winning trade in my own account. How about you?
Absolutely. I often, I pray for the ability to do that for all my students. And when I see that, it's such an encouragement, not just as a trader, but as a human being, because today's world, we don't see a lot of that. And if I can be a positive contribution to that, to help them build a better family life and provide for other people, that's a win-win situation for me.
Yeah, so I think that you and I have that in common too. Of course, we want to do well here, but we're also laying up treasure somewhere else, aren't we?
Amen.
Okay, buddy. So I'm looking forward to hearing what you have to say about how you formulate your daily biases. I see the risk disclaimer. Everyone here knows that you shouldn't be trading with your mortgage money. In fact, Michael, you know what I used to do when I had my own IB and I was a broker and
What's
someone
that?
wanted to open an account with me?
What's that,
I
sir?
would say, see that check that you're setting this account up with? And they go, yeah. So I want you to imagine striking a match and lighting up that check. And if that makes you nervous, it's not risk capital. I don't want the business.
Right. It's a good
Right.
analogy.
Okay. So everyone here that hears us every day and hears you, they know this is high risk. And you know what? You can't click the mouse for anybody and they can't click it for you. We're all captains of our own ship anyway, in my
Absolutely.
extremely accurate and humble opinion.
Absolutely.
So let's proceed, buddy.
All right, sir. First of all, thanks for having me back. I think it was a little bit over a year ago, the last time I was here.
Yeah.
And the discussion I want to have today is something as an educator, I get this more than any other question ever. It's the daily bias. And you've been in the education business it's just as well as anyone else. And isn't it something of a frustration to try to communicate to folks that just because a daily bias can be derived, it doesn't always mean that there's a daily bias for every single day.
Right. Yeah. Tom Petty, the waiting is the hardest part.
Right. And the folks that you guys got collectively here, I can appreciate what you're doing because, number one, you're providing a service for a community and you're trying to grow a community, which is fabulous, but it's also very hard because you're going to have varying opinions, different styles. The audience members are going to be so diverse. The complications come with trying to form a bias that will still complement your specific criteria or your model. And today, I kind of wanted to give a very generic approach to how, using what I understand about price action, how anyone can come into the marketplace and just simply plug and play this, I guess, concept. It's not so much a trading method or a system or anything like that. It's just a way of interpreting a likelihood scenario.
Okay.
Now, I do lean on this a lot, and there's a lot of things that I can't obviously cover, not because of the protective side of the thing, but the time. It takes so much time, and I could talk on this literally every single day with you for 6 or 7 months and really not really scratch the surface of what's available. And I'm going to give you a primer for your audience to kind of go into the charts and see if what I showed you today is in fact what actually happens on a week-by-week basis. I actually use this every single week on Twitter. So when I'm sharing my examples, when I'm doing trade executions and you see the results of that, a lot of that is actually hinging on what I'm going to show today. So you're going to be able to see that stuff, not just because I'm using a past example here to communicate the concept, but it's important for the viewers to go back and look at the things I'm suggesting today here, because it's the same signatures in every other example. So it's as generic as I can make it, so that way anyone, whether you're an Elliott wave theorist, whether you like harmonics, it will still complement that theory. At least that was my goal going into it.
Okay. All right. Well, I have confidence in you. So Michael, I said that I expect Michael to lay out enough pearls to string a necklace. So let's go ahead. I'm eager to hear it.
Okay. All right. Start off with some initial thoughts and concerns. Obviously, as I mentioned at the beginning, daily bias is not an everyday trading bias. So new traders or relatively new traders, they feel like the folks that are consistently profitable always know what the market's going to do next. And I get that a lot. And I kind of promote that as a caricature on Twitter. But admittedly, there's some times where I just simply don't know. And I have to sit on my hands and wait for more information. So
yes,
it's important.
Let me ask you this. You've been doing this a long time.
Yes, sir.
Say like 20 years ago, Michael,
Mhm.
when you were in a situation where you really didn't know, did you used to feel uncomfortable just even saying that?
I wouldn't admit it. I would
Yeah,
never.
okay, right. And you'd come up with something. You'd
Yes.
find a reason. And so again, wisdom is being able to say, I don't know, and wait for, as you say, more information, more price action to give
Right.
you reasons, like a good lawyer to build a case that's
Right.
compelling enough to take risks. So I don't know. You never see that on Twitter. You never see, I don't know, and
Mhm.
I was wrong on Twitter.
Exactly.
Do you?
Right.
Have you ever
Well, I
seen it?
don't see it a lot. I try to encourage it, and I try to
Yeah.
walk that walk by my own actions. But
Yeah.
no one knows everything. No one knows what the market's going to do minute by minute. And the worst thing I could do as an educator is to try to promote that idea or theory, because there's a lot of times where I just simply, and I actually started this week with my group. I said, look, there's a lot of landmines on the economic calendar. I don't really technically trade this week past Tuesday. Tuesday's like my last day,
Because
and
of the
I don't
Fed?
worry. I'm sorry, sir.
Because of the Fed?
Well, that and non-farm payroll. Typically
Okay.
Monday, Tuesday, up to Wednesday's New York Open. That's like the cleanest price action you're going to get. So that's extra. I'll toss that in there for an extra charge. But you guys can look at that on your past data and see that, with the exception of the volatility that comes by way of non-farm payroll, which in recent years hasn't been a whole lot, but that uncertainty that it causes, if you're trading, especially from an intraday basis, because I focus on that mostly, the pure price action is Monday, Tuesday, and Wednesday, stopping around New York Open on Wednesday. After that, if I have any positions, I'm closing it and I'm just watching the rest of the week.
Okay. Fair enough.
The daily bias, again, I'm not trying to promote or push the idea that you need to go in every single day and determine hardline it's going to be an up day or a down day. That's not what I'm focusing on here, and I don't really trade with that either. I look for
I
one good
understand
setup.
that. I understand that. You're saying, Sika, I could tell from your voice that you having to repeat that over and over again, that a lot of people don't get it. But, a lot of traders, Michael, they'll start from monthlies, weeklies, and dailies, but they may fine tune an entry with an hourly, but
Mhm.
then manage it from a 4 hour or daily. So, I mean, there's always something to do on a 15-minute chart. Right,
Absolutely.
but
Absolutely.
if you stick your daily biases, sometimes it takes days, maybe even a week or so, for a signal to be generated, because it's a much wider risk trade on a daily if you're just using that, and so entries aren't as opportune all the time until it's at a critical juncture, right?
Exactly. In concert with what you mentioned earlier, you gave a historical reference to how it was for you as well. And I admitted the same struggle. Anyone that's been doing this for a long time will admit that there are periods where you don't know what you're supposed to be doing. And those are the very moments that I can look back in my journals and see where I did the most damage to myself and my own accounts. Because you want to get in there and you want to get out of that uncomfortable feeling of not knowing what's going on. And you chase the price action. Whatever's happening at the moment, you chase it.
Very important to anyone listening, start journaling. Write it down. Thanks, Mike. Go ahead.
No problem. Well, there's days, obviously, uncertainty is going to be there, and you want to be aware of that and be comfortable turning the charts off and coming back another day. If it doesn't jump off of the chart, it doesn't give you a very clear bias. That means it's absolutely one-sided, and it's easy to see that. It's hard to wait for it, but this is the focus of what I'm going to be teaching today. So again, there is no panacea method for determining a 100% accurate daily bias. So while it's important to know that we can get to a very high probability, that is never a guarantee that it's going to pan out like that. And that's the reason why we have to use stop losses and good run management. So avoid the need or the impulse to chase perfection. I'm not perfect. That's my goal, but I don't ever really achieve that. I got a really good strike rate, and I'm comfortable with that. But I only look for one good setup per week, and if I get that, I'm done for the entire week. You can do very, very well being correct most times. And the reason why I have most in apostrophes like that, it's not most in sense that it's 20 technical trading days per month, and most of those days you're right. That's not what I'm referring to. The most there is referring to the setups that fit your criteria, that make sense technically, and that you're comfortable with taking it. So everything has to be in alignment. You're not forcing the trade. You're not trying to impose your will in the marketplace. You're remaining flexible enough to know what it is that you're looking for and patient enough to wait for it. When it comes, you'll know it because you've been back testing it. You've seen many examples of it, so you'll trust it. But that doesn't happen every single day. What I've learned is my biased side of trading is very strong on the Monday, Tuesday, and Wednesday side of the week. If I'm bullish on the week, my buy days are going to be ideally Tuesday and Wednesday. I want to use Monday as my analysis day to kind of confirm, did we open up like I was expecting? Did we have any kind of initial shakeout during Monday's trading? And then I look for that weekly analysis, either bullish or bearish, to manifest itself or start on Tuesday or Wednesday. If I don't get a bias that lines up, or say I take a loss on Tuesday, I don't abandon my bias. I go into Wednesday with that same bias. So I'm not trying to change gears a lot. I stick to one side of the marketplace. I don't like a plan B. I like to go in with one side in mind and focus primarily for that. If it takes all day until New York or late London close to get that entry, it's still an entry for me.
Okay.
So what causes markets to move directionally? Well, the market seeks liquidity. Now, we as traders, we like patterns. We like classical support resistance. We like trend lines, moving averages, and all those types of things. And they all have their place to some degree, and everyone's learning. But the market's going to go where the orders are, period. That's all it is. And if we understand where those orders are, and then like your Twitter handle is, Forex Stop Hunter, and you kind of subscribe to that theory too. I mean, the market will go to where there's liquidity.
Yeah.
So
I saw it as a runner on the floor. Like,
there you go. So it's not something that's contrived, or it's not a conspiracy. It's a fundamental aspect of how trading markets work. So
yeah,
the theory is,
Mr. Market, he's so mean.
yeah. So someone, and I'm referring to the smart money collectively, okay, always has an invested interest in exiting at a higher price or a lower price relative to the current market condition. So I try to look at that as my underlying narrative. Who's most likely correct right now? And it's going to be the movements from the monthly, the weekly, and the daily chart. The large funds and the large institutions are not actively monitoring 1 and 5 minute charts. It doesn't mean that you can't use those to fine tune an entry and lower risk with a higher time frame perspective. This means that my analysis starts from that long-term higher time frame, because I believe, and it's my understanding, that the markets will actively look and seek liquidity. And who would have a larger vested interest in seeing liquidity be purged above an old high or below an old low than large institutions and banks? So that's the underlying theory that kind of like prevails all throughout my concept. So you can look at it as the boogeyman theory, or the quote unquote the market makers out to get me type thing. I don't look at that as them out to get me. I'm trying to get in alignment with them, and I use that as a perspective of institutional order flow, not in the sense that I'm looking for tools or technical indicators. I'm looking at price action alone. All right, so when we look at price, or at least how I look at it, starting with a monthly chart, I want to kind of see where the largest draw of liquidity would be on a monthly basis, because again, large funds, big, large institutions, they're going to be largely interested in the liquidity that's provided on that scale, not something like you and I. I mean, we're such a small fish in the sea. They can't counterparty with us. So the vested interest is above old highs and below old lows. Looking at this monthly chart, it's important that this is something that had an analysis slant for me personally. So in my group, we look for things like this. Obviously, right away, you can see it looks like a double bottom on a monthly chart. Now, as a retail trader, I learned that was a support level. Okay, and I learned to try to trust that as a basis for trusting buy signals. I learned by many examples getting burned by that I had to change my perspective on it. So I went into the markets looking for the opposite to happen. If I see that happening, where the market creates a double bottom or a double top, I'm expecting a scenario that they'll run through it and go below it. So the focus is going to be these relative equal lows. And for the sake of explanation, that low for that period is 112.15. So that's going to be the level that we're going to be using as an example. This same approach is used in any market, any asset class. Okay, so it's not just a Forex thing, because I'm kind of like known for Forex. I did the same stuff with S&P. I've called the recent move in S&P relative to the equal highs on the S&P daily chart. I think that's what we're aiming for.
Do you agree, Michael? The only difference is the title, the beta, and the leverage.
Yes. Yes.
A chart is a chart is a chart.
That's it. Price is price. It doesn't make a difference.
Okay, bro.
So moving on into that monthly perspective, whenever we see, or whenever I see a turning point, a swing point, all I need is 3 candles to do that. I know that there's a likelihood that the market will expand to the downside. In this case, we see a swing high that's noted by that arrow that's pointing down. That's the highest of the 3 candles, one to the left, which is an up close candle, and this candle right here. This completes. When this month closes, the very next trading day, I would hold a bearish market bias for the euro dollar with the expectation that it would hunt this liquidity. So right away, you got 80% of the work out of the way. You know what you're going to be hunting for at the beginning of the month.
Right.
So what we're looking for is, in terms of high probability, is you want to see the expansion, not the completion of the monthly candle. You just want to see the expansion directionally higher or lower. In this case, we got a swing high forming. We have a double bottom formation, pseudo double bottom. And I believe that that would be enough to warrant a look, if you will, a deeper inspection of whether or not there's going to be something that would provide a run down below that 112.15 level.
Okay.
On the weekly chart, we start the week on Monday. I don't look at Sundays so much. I used to in previous years, but I just don't worry about them anymore unless it's a big, strong gap. But apart from a gap, I'm not really considering Sunday's data. So Monday of the first trading week of March, I'm going to go into the marketplace looking for a scenario that warrants expansion on the downside, and I'm going to be looking for 2 things to happen in the marketplace. On an intraday basis, I use a 15-minute and 5-minute chart generally for my fine-tuning of the entries. But I have to look for setups to anchor on, because I just can't indiscriminately go in there and just, I'm bearish, I'm going to sell short because it's Monday and I have nothing else to do, or I'm uncomfortable waiting. I'm waiting for something specific. And I want to wait for some kind of a proof, if you will, that the markets are in fact starting to move in that preconceived idea of a bearishness that I've arrived at only from a monthly chart yet. On the weekly, I note the same level as it's shown here, 112.15. I think the draw is going to be on that. In other words, I think the market's going to want to go there. So in the beginning stages of when I started learning as a trader in 1992, I was focused about getting in the entry pattern. Give me the entry technique. Give me the where should my stop be? And I didn't spend a whole lot of time with where's the market likely to go to and why. What's the reason why it should go to that specific level? Not so much because you can give an excuse. I mean, think about it. You've been doing this a long time. How many theories and concepts is there to get you into a marketplace? There's hundreds of them, right?
Yeah. But you have to find something that suits your personality.
Exactly. So what I had to do was work on that weakness of mine, which was understanding where the market should go. If it's reaching for something, there should be some kind of a narrative or storyline that would justify that. And if I see signatures or elements in price action to support that, then I have a loaded deal in my model. That doesn't mean I'm going to be right. It doesn't mean it's always going to pan out. It just means that I have a high probability scenario that's defined by my model. So starting the week here, and this is the first week of March, we'll be expecting downside expansion. And again, I'm not trying to predict the close of the month. I'm not trying to predict the close of the week. I'm just looking for volatility in a predetermined direction. In this case, it's bearish. Have I made the point of why I think it's bearish clear enough?
Yes, to me.
Okay. So moving into the daily chart, what I've done here is delineate the chart to a point where you can see in very short fashion the market does in fact attack that liquidity below 112.15. Now,
and that was it.
I'm sorry, sir?
And that was it.
Yes. This low, I don't think of it as this is old support, so therefore when it trades down here, I want to buy it. when I'm above it, I'm thinking I want to get under there because there's going to be liquidity under that. And that's what the market, in fact, tries to do almost every time frame. If you understand where the most recent price move has began, then you know where the liquidity is. And there's a lot of discussion about where's
So
the
you
stock.
use the word liquidity.
Yes,
And the liquidity, a lot of the things like when taking out lows and highs are about electing stops above the market, below the market. People ask me, Dale, how do you know where the stops are? And you just showed us an example. You had a key swing low. People go, I say, just imagine you're long. Where would you put your stop?
Mm-hmm.
And they, will say under that swing low. I said, well, that's where everyone else's is too. Don't put yours there.
Right.
And maybe even take advantage of it going into there. So
Yes.
a lot of these are stop hunts that when you say going for liquidity, would you say 90% of going for where the liquidity is are stops, Michael?
Yes, that's
Okay.
what I refer to it as a low resistance liquidity run.
Okay.
And it's something that if you go through all my free tutorials, it kind of like repeats itself over and over again, different little components of it. And all I'm trying to do now is just break it down so inside of a 30-minute discussion, you know exactly what you're supposed to be doing.
Okay.
And then you can practice with it. And then your audience can go back and see it's there all the time. Every single week, it's doing something just like this. Every single week. And I'm only looking for that one scenario that fulfills that role. So it may not do it this week in euro. It may not do it in cable, but it might do it in dollar Swiss. It might do it in dollar yen. It might do it in gold. It might do it in S&P. I have a small, very small universe of markets that I follow, but I get a setup every single week.
Okay, let me ask you this. Why a small universe? I think I know the answer, but why don't you tell us why?
Well, personally, I have attention deficit disorder, and I have a very short attention span. So it's easier for me to manage that, but I think it's also something that should be done as a new trader, even if their interest lays with having 28 markets to follow at some point. Initially, you want to have your focus on one or two and just learn trading on that. If you try to do too many things, if you look
you lose your focus.
Yeah,
you lose your focus.
Exactly. You can't adhere to a model, especially if we look at currency pairs. The dollar going up should mean all the other foreign currencies bend the knee to it and go lower. But sometimes that doesn't happen. Sometimes some foreign currencies consolidate, and it can be very frustrating. So if you just reduce your focus to one or two and just simply use a barometer like I do, the dollar index, I mean, if I had a gun to my head and I was only told I can only trade 3 markets or follow only 3 markets, it's what I'm doing now. It's the dollar index for overall directional bias, and then I mirror that with my euro dollar or British pound. That's it. They're the only 2 markets I really actively look at.
Okay, it only takes one too, Michael. You know how many guys never left the cattle pit at the CME?
Exactly.
And were driven home by chauffeurs?
Exactly.
They didn't care what was happening in the hog or belly pit. They knew one market like the back of their hand.
Yes. And when you say they knew the market, it's not that they only know that technical aspect of trading for that market. They know the levels. They know where the levels are for that number, for that.
They also held the stops in their hands.
Exactly. 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 They're the inside track.
Yeah.
So if we're looking at the daily here, I want you to think about it in terms of what we would expect or what should be expected, a run down to that low, attacking that liquidity. The reason why they're going to want to take it down there is for us to get out of a short, we got to buy it back. Okay, so if you see there's been a really clear lower low, lower high, lower low, lower high. It's every classical depiction of a bearish market there. It doesn't mean that you may have been able to discern this as a sell scenario, but any day in the week here, you could start off with that same premise that, okay, I may not have gotten in up here. Maybe I missed Monday's move. I don't care about Monday's move. I'm looking at Tuesday and Wednesday because I know there's going to be a strong probability that I'm going to get the beginning of the weekly expansion on Tuesday or Wednesday when it's a bearish market. I might miss the ideal highest high on Monday. I don't care about that. Tuesday, and you referred to it, I heard it at the beginning of the analysis side, turnaround Tuesday. That's, it's real. It really is real, and it's something that is important for someone that's going to be an intraday trader or short-term trader. If it's a long-term position trader, not so much of an interest, but it's fascinating to see the reoccurring phenomenon like a Tuesday, high of the week or the low of the week formation. But if you have a bias that starts ahead of the week, you can sit on your hands and wait comfortably, wait for Tuesday's price action, and then you have something to work with. Whereas a new trader or someone that without a model or without a procedure, they're being constantly pulled in all different directions of what they should be doing. And they go into Twitter, they go on social media, they go to other websites, asking everybody else, theoretically, what they should be doing. And that's not a trader. That's someone that's following. So.
It's a tragedy waiting to happen.
Yes.
Yeah. So what do you think of Euro? Where's Euro going? Up, down, up? When anybody asks me a question, is it going up or down? I usually say, you know what should go down? Your platform. Shut it down.
Yes, exactly. As soon as you ask someone else your opinion or their opinion about the market, it's not your trade anymore. It's not yours. And so how
can they learn too? I mean, but just by following someone and hoping money will drop into their account. Exactly. What I like about what you do, Michael, is you teach your mentees the whys. That's the most important part. Not whether the trade is successful or not, because when they have the whys, when you're in an island and you're burned out from teaching and you don't want to do it anymore, you've left them with tools they could use for the rest of their trading career. They know the whys.
Right. Well, we're going to take a big jump ahead. From moving from the monthly to the weekly and the daily. Everyone's familiar with a standard top-down approach. What kind of like separates me from the rest in terms of my view on the marketplace is the order block. Everyone kind of like draws that assumption, okay, oh, that's that order block guy. And it's many times related to, erroneously, I think, that it's supply and demand. It's not supply and demand. It's a very specific component that's in price action. And while every supply and demand zone in that classical view of price action, I don't subscribe to that. I have to have something that supports the idea, and then I have a specific price level in mind. I'm not looking at a zone. I'm not looking at an area. Okay.
You're not a good prospect for Online Trading Academy.
Yeah. Unfortunately, I'm not. But I think it's a good. Again, it's a good foundation to start traders thinking like that. Yeah. But I think if anyone spends time with it, they'll outgrow it.
Okay.
So I want you to take a look at this level right here. This is a bearish order block. Now, what makes it a bearish order block is the fact that we had a swing high here, and it's the last up close candle.
Okay.
Institutions, large banks, large traders, they have to move a great deal of size. And if you ever talk to anyone that is a large trader, they have to move in the opposing direction to get the proper counterparty for liquidity purposes. This run up, this is a very high probability signature if we trade back to it after it drives away, in order to move quickly away from it. I don't care about how far we go down. I don't care about any of that. All I'm waiting for is a time for it to trade right back up into it. Notice going into March, we already had a bias that it should go lower.
Right.
This is the key level you would be waiting for, the very, very low. Now, if it were to hit this level at a specific time of day, like a London Open or a New York Open, the probabilities go through the roof in terms of it's going to be sensitive at that level. I'm going to tell you it's not necessary. You don't need that. What you're going to do is you're going to wait for that same pattern to form. What I showed on the monthly chart, the swing high, you're going to see it's same pattern here fractally. We have a high, a higher high, and a lower high. So it's 3 candles forming at a bearish order block. If you see this signature on a daily chart and it's in concert with a weekly and a monthly bias that's bearish, all you're going to do is go into the next week on Monday, Tuesday, and Wednesday, anticipating a expansion on the downside. But the caveat is you have to have a level that's determined. Now, if we just completely looked at a daily chart and take the monthly and the weekly completely out of the conversation, you still arrive at that same fractal of here's a stop hunt right here, waiting to be taken. Okay, so all I did was use the higher time frame monthly because there's going to be a larger pool of liquidity below that monthly low.
Yeah, got it.
Okay. So we're in a daily. I've mentioned here on the chart and annotations that the market sees large candles running down into the liquidity pool relative to that low that we've determined on the monthly. If you look at that portion of the movement right there, that is the entire weekly range on the downside. That is enough. Now, if you just take a third of that, for me, I think that's fine. There's nothing wrong with that. I think it's a reasonable objective to hold for a new developing trader. Most books aren't going to tell you to do that. They're going to tell you to push your edge as long as you have your edge. I've learned that your edge, if you keep using it, it dulls it. So I have to really pick your place and time when you want to use your edge. And that's the experience factor. You're not going to get this the first time you look at it. You're not going to watch this video and say, okay, I'm going to crack open pound yen, and I'm going to destroy the market next Monday and Tuesday and Wednesday because I watched this video. You need to look at it, study it, and do back testing on it. But you'll see that it's always there. It's not something that just comes around once in a while. It's every single week it does this.
No, to develop a new habit and a new paradigm takes multiple repetitions over time.
Yes. So moving into a 4-hour chart, now it starts getting a little bit more interesting because this is the part that takes you to exactly knowing when the market should expand. Now, this is Monday's trading here. The market starts to drop lower. That, to me, is a confirmation that the institutional order flow has now began its movement lower. I don't need to be a part of that move. I don't care about being part of that move. What I want to wait for is an up-close candle and another punch lower. And that's what we got right in here. So we have these two candles. This is very important because everyone that watches my videos on YouTube, they go around and create things, okay, and groups and teaching people other students order blocks, and they don't really understand what an order block is. If you looked at this candle here, most people would say, okay, that's the bearish order block. That's not the bearish order block. The order block is this. The reason why this is the order block and not this candle is because this candle on here, the two back-to-back candles, that makes one single order block. It's one consecutive reference of time. Price started at here and it closed higher here. Which candle has the higher close? This candle or this one here to the left?
Yeah.
Obviously the one to the left, right? So the higher bodied candle, that's the actual order block. So you use the low of that candle, and that's going to be the most sensitive price point. If it trades back to the body, it's even better. The difference between whether using the wick or the body is how much risk are you willing to incur. If you drop down to a lower time frame, that may not be that big of a deal in terms of where your stop should go, or shouldn't have any impediment to using the same risk model that you're using. Say you're using 1% of your equity. It may not change it if you use the entry of the bodies open or the candles low. If that's either one's good. I like to use the wick. And in fact, many times I'm going in about 5 pips ahead of that low because I'm not certain that the market's going to go up there and give me enough time to get my order filled and punch up into it. Everyone's spread's going to be slightly different too. And again, that big movement happens after it hits the 4-hour order block. So for the listeners, everything up to this point here probably sounds very similar to classical support and resistance and classical top-down analysis. The thing I want you to take away from it is if you have a bias that's derived from the monthly, the weekly, and the daily, and you expect some daily low to be ran out or a weekly or a monthly low to be taken out, that is the basis of your foundation to a daily bias. Now, notice that every single one of these 4-hour candles is not a down close candle. There's some retracements in there. You want to see this retracement happen and still have that range unprobed. In other words, this low, that 112.15, this is untapped liquidity. So if we get an up close candle and it trades right back up into that, that's the setup. And then what is your bias? The very next candle or the very next day, you're selling short. You want to be selling short. So did I say the daily bias for Monday, Tuesday, Wednesday, Thursday, and Friday is bearish and I'm going to enter on it? No. I said that every day I'm going in looking for what? Here's the takeaway. Watch the 4-hour chart. If you're bearish, you want to see an up close or consecutive up close candles. If the market trades away from that, lower, in this case because we're bearish, if it trades back up to it like it does here, that's your sell. That's when your bias is 90% plus. It's going to go down and then attack that liquidity.
So a retest of the order block.
Yes. Now, The only caveat is you may not have an up close candle on the 4 hour, and the only thing you need to do is drop down into a 1 hour chart. The 1 hour chart is still going to provide that same thing. Here's an hourly chart. I'm using the 4 hour order block here, but I refined it to this. If you go back, if I show you this one, it's on the body of the candle here. This one here, I actually refined it and moved the level right up to these two candles, because these are the highest up close bodies, and this one, even though it has a very small body, it's still up close. So consecutively, you have to incorporate both of these to create the order block. And again, the same model is you use the low of the candle, and me, I'm going to be in there 5 pips below the low of that order block. That's where I would take my short. So while I would probably have 5 or 6 or 7 pips of drawdown, and I'm comfortable with that, I would enter on that, and that would be enough. For a daily bias, this is the day it hits it. So the very next day, I'm selling short. I'm going into London, because London has the likelihood of creating a high and low of the day. If you have a bias.
Yeah, why is that, Michael? I've noticed that for years. And you know any reason why the majority of turns happen in the London session?
I have a theory, but it probably won't be in alignment with most of your viewers. But I believe the price is delivered by an algorithm. It used to be open outcry and all those things. But I think I can prove it if we sat down for a little bit of time, that everything, especially in the currency markets, are delivered by an algorithm. I don't think that it's like what people think it is. It's not a free market. I think it's 100% manipulated, and I think the daily high and the low is formed and determined before midnight every single day. And it might be uncomfortable to hear that if you're a trader and maybe you've been trading for a long time, but I kind of prove it like every single week. But again, that's outside the scope of our discussion.
Okay, bro.
So the very next day we have the open, and I'll show you what that open is in a minute, but the price runs initially higher. Now, as a new trader, when I first started, I would see this because I'd be watching 5-minute charts on Supercharge was the program I was using back then. And if I saw a 5-minute chart start tearing off the outside, I'm not thinking selling short. I'm looking to buy it. So there was a paradigm shift in my understanding that all of my losing trades, I was always chasing price. I was chasing it. If it was moving fast in one-sided direction on a very short-term time frame, I was in there. I was doing S&P bonds. They were on 2 markets. I was trading as a futures market trader. And I was getting burned constantly. And then I realized in certain times of the day, it would do these like fake moves. And I just dubbed it as a Judas swing, like a Judas goat leads people into, well, not people, but leads sheep into the slaughterhouse. But right before the slaughterhouse entry, it goes off a slightly different path, and it's not going in the slaughterhouse, but the sheep get slaughtered. So this to me is like a Judas swing. It's a fake move. When that happens and it runs above a short-term high, it's the same stop hunt, just in the opposite. So we're going to use this order area here, okay, of liquidity. What's going to be resting above that, Dale? Right above this short-term high, or if it went as high as this, what would be resting above this high? Either one.
At least one buy stop.
Exactly. There's liquidity on the buy side. So if you're going to be selling short, wouldn't it make sense to sell in a very rich pool of liquidity of willing buyers? You want to sell it to them?
Yeah.
That's what the market's doing here.
When they line up to buy something, sell it to them.
Exactly. So building a short position with the bias, pairing your order with buy stops, a known level that's clearly, you can easily see it. They run that. Now your bias, the bias that's been determined from a large liquidity pool from a monthly, the weekly, and the daily, that's your target. You're not getting out with 10 pips profit. You're not getting out 25 pips. You're not looking at harmonic this and on trend lines that. You're looking for where the orders are, and you hold for that. Now you can take portions of your trade off at things like patterns and expansions and Elliott wave type things. All that's possible. You can still do that, but always hold a piece of the position on to get down into this area. And I want to kind of talk a little bit about this area right in here now. Moving in from that level right here, again, this is that order block. That has to happen on a Monday, Tuesday, or Wednesday. Notice this is Monday's data, this is Tuesday's data, this is Wednesday's data. Again, I'm not trying to teach an everyday bias. I'm teaching you, if you want to sit down, you want to find one good setup per week, this is how you do it. If it does not form an order block on a 4 hour, it will form it on an hourly. And then you simply trade it when it hits there or use the very next day for the bias to unfold. The better scenarios are going to be when you have enough range between where the signal would form on the very next trading day in London. This is important also. I haven't mentioned it yet. Ideally, London is your entry, but if you don't get it in London, you can do something in New York if it creates like a 15-minute order block. Again, you'd see a up-close candle in a 15-minute time frame, trade into that if it allows it, and then you may not get the best scenario, but you're still trading with a bias and you're still trading with higher institutional order flow. And there's your big move here, and I'm going to go into the last bit of details with it. The weekly range in focus. We're looking at a 15-minute time frame, and every single day here, there's a small little blue line. This is delineating 0 GMT, and this is going to be your opening price. If you have a bias, if you're bearish, your ideal scenario entries are going to be selling short at that opening or just above it. If you're bullish, you want to be buying at that opening price or just below it. Now, when you reach the higher time frame liquidity pool, as we outlined here at that 112.15, what's just below 112.15? Big figure, right? 112.
Yeah, big arrow.
In your experience, have you seen the markets always stop right at the big figure number and turn around?
No.
Right. There's going to be some measure of liquidity and orders that stack above, below, and sometimes a little bit deeper than just a 10 pip or 15 pip run.
In fact, Michael, and that's the last interruption. When everyone's looking for one price and it's bandied about quite a bit, it either doesn't get there or it becomes meaningless if it does.
Right. So
have you seen that too?
Oh yeah, absolutely.
Yeah,
absolutely. The more talk about a number, the less I'm interested in it. I'm not concerned myself with it.
Okay.
So Thursday, we see the price drive above that opening price. There is your cherry right there. That's what you're looking for. All week long, you're going in every single day with a bias. I want to sell short London. I want to sell short New York. One of the two, I don't care. Monday, yes, it drops down. It gives me the confirmation that, yes, institutional flow is starting to move lower. Great. Now I want to see the market show displacement. I mean, displacement is a sharp, sudden move in one direction. In this case, we're bearish. I want to see a sudden move lower. We see it here, right in here. Here's that return back to the order block. Now, this is London close. London close on Wednesday. Now, some people might say, well, I don't want to enter in London close. Well, you don't have to. You can, ideally, but you want to use the very next trading day for your bias. That means the bias is going to unfold generally on Thursday. And now think about this. If the market has been slightly lowered and consolidating, and you know that this is a large draw on liquidity, in other words, there's a big pile of stops below that, and it's Thursday, and how much time of the week do we have left? It's not much time left, is there, in terms of days? I mean, you have Thursdays trading, and then you have Fridays trading. And Friday, many times, doesn't have a whole lot of follow-through. It's usually capped by Thursday's price action on the weekly range, or we get a complete reversal on Friday. So from a weekly range standpoint, I know that this deal, okay, with a bearish bias is going to have a lot of magnitude and expansion with speed. This is a big hallmark to one of the biggest learning curves I experienced with studying time and price. Because the weekly range, up to this point here on Wednesday, yeah, it's handsome. I mean, it had a little bit of a downside movement, but it didn't really expand explosively. On that Thursday, I challenge everyone to go look at the economic calendar for March 7th, and you'll see the economic driver that was already in place. Just like we can look at the economic calendar this week here. We have FOMC, we have non-farm payroll, we have some big, heavy, risk factors in the economic calendar. On this day, you're in here with ECB, so it's
okay.
It's a big magnitude event. But the bias was already determined from a monthly chart the previous month. So even though it took 7 days of the calendar of March to get to that particular day, every day you go in looking for a scenario. You have to have several things in place. The bias you determine from a higher time frame. Where's it going to go to? That's the liquidity pool. What are you waiting for? You want to have confirmation. What confirmation is that? You want to see that the market starts to drift lower and then it gives a sudden sell-off. What that sudden sell-off does is that it's a footprint that smart money has really moved a great deal of size. They can't put all their position on in that first move. So you wait for them to come back and give you a double tap. When it gets up in here again, whatever portion they couldn't get in on their first move, that's where they're going to do it. And then once it does that, it does not
They
spend a lot
have
of
one
time.
more chance too.
Exactly.
Yeah, interesting.
So
Michael.
the higher time frame liquidity purge that takes place below 112.15, when it gets to the 112 big figure, I always anticipate 10 to 20 pips below that. And we see just about perfectly 20 pips below it sweeps down. Now, this liquidity has been purged. Now, can it go lower? Absolutely. But what I do is I move to a neutral stance. But if you're a day trader or a scalper, you can switch and go into reversal mode. So as I mentioned, when we're bearish, you sell at or above that opening price when you're bearish. What do you do when it's bullish? The opposite, right? So you'd be buying below that opening price. Once we hit this pool of liquidity, watch what happens. Price goes below the opening on this day, rallies higher. It goes below the opening here, rallies higher. Goes below the opening here, rallies higher. Goes below the opening here, rallies higher. If you know what you're looking for and any one of these days here fits a criteria that you have with your discipline, or if any of these days over here fits your criteria with your discipline relative to the bias, then you have an opportunity to engage at the marketplace using a daily bias. But it's not a daily bias that has to happen every single day. I don't have a daily bias every single day. I don't have a daily bias, every session. I could have a session that's bearish London with the expectation it's going to reverse in New York. Is that a daily bias? I guess it could be called a daily bias, but I look at it as it's a session bias. So I tried to strip this down to make it as universally applicable to any discipline. You're using a higher time frame chart to note where a large pool of stops are going to be. There has to be
Mission accomplished.
You think so? Because I tried to think about this for about
I
a
do.
week.
I believe people are going to have to watch it more than once to get it.
Right.
That's why we record it. But an excellent teaching tool, a great tutorial on just scratching the surface of what you do, Michael. And you know what? I want to thank your giving spirit for paying it forward and coming out here and giving it away.
I appreciate you having me here, and hopefully your audience has found something useful from it.
Thank you so much, Michael. I really am glad that our paths crossed on Twitter, and appreciate you being and accepting being my trading warrior brother. That's a lifetime thing,
I appreciate it.
Like it or not, I would. And you can't show anyone our secret handshake, or I'd have to kill you. All right, buddy. All right. So everyone, thank Michael for a great presentation. Yes, everyone's asking. It will be. It was videotaped. It'll be tweeted. It'll be on our YouTube channel. And we'll see everyone for Turnaround Tuesday. Welcome, Glenn, Derek, Gilbert. Thank you once again, Michael Huddleston at IMCT Trader and Inner Circle Trader. And maybe one day I'll become an honorary Inner Circle Trader. And remember, don't just count your pips, count your blessings, everybody. I think it was a blessing to have one of the best interviews of the year here today to start our week off. And I'll see everyone for Turnaround Tuesday. Good hunting. Thanks again, Michael. Appreciate it, buddy. Adios. See you, Mark.